When we hear the word MPT, which is modern portfolio theory, the first name which pops into our mind is Harry Markowitz. So Markowitz was the scientist who devised this theory of MPT, and this theory he had come up with this theory a few decades back, and it still remains relevant in contemporary markets. So when we talk from a portfolio management perspective, this is something which is still being used by portfolio managers. Now, just like any other model, even the modern portfolio theory follows a certain set of assumptions. A few of them are unrealistic in a practical circumstance, just like something which we observe in Black-Scholes. So even we know that when we study Black-Scholes option pricing, we are following a framework of Black-Scholes. So yes, a few things in Black-Scholes like maybe a constant risk-free rate or maybe a constant volatility. That is something which may not be acceptable by the market all the time. So market applies certain enhancements on top of it when it uses that framework for analysis. So something similar is used in terms of the assumptions which go into MPT. So a few of them, although they may be more from a theoretical perspective, they are right. From a practical perspective, some changes have to be done, and the market understands this and it appreciates this. And fund managers apply small tweaks to this when they actually use the MPT framework for analysis of various investments. So going through the key assumptions which form the modern portfolio theory, we assume perfect markets. That is, we assume markets which are information efficient. There is no friction. So when we say information efficient, that means everything or all of the available market information is captured in the market prices and there is no friction. So that way, any kind of trading activities which are to happen, they can happen smoothly within the market without any hindrances. We don't assume any segmentation in the market. So that will ensure that trades can happen smoothly. Then there is a perfect competition which exists between market participants. So we assume a fair market. Then transaction taxes and any kind of transaction charges, they are assumed to be zero. And all the assets are marketable. So trading of assets becomes easy. So these are a few assumptions which goes into understanding of the modern portfolio theory. Investors are assumed to be rational, that is, they are risk averse. So what do we mean by risk averse is the investor will look at a certain investment in such a way that they will try to minimize the overall risk to which they are exposed to. So that's what we call as risk averse investors, and we call them as rational investors. So the idea is investor will be willing to take on a certain amount of risk which is higher in quantum only if there is a certain expected return which is higher. So always study everything in terms of risk and return space. So that brings us to the next point where we say that the asset allocation depends on the expected risk versus the expected return graph. So you can imagine this to be like a very simple two-dimensional chart. So we'll study these things in elaborate details in the subsequent slides. But for now, we'll have expected return, which is there on the y-axis, and we have risk, let's call it by the standard deviation, on the x-axis. And every investment which we are going to study, that will sit inside this risk and return framework, as we call it. Because this is the risk and return space, and every asset we analyze, we'll analyze it from these two perspectives. So the idea is for a certain level of risk, we have a certain level of expected return. Now, we know that investors are rational. So if we want an investor to take on slightly higher amount of risk, naturally there should be a certain portfolio which is able to generate a certain higher expected return. Because only then will a rational individual be willing to take on some higher degree of risk. Now, also, as a part of this analysis, we are taking into consideration just two statistical properties, which we call as mean and standard deviation. So just to show this statistically, if we look at a simple Gaussian, now why I'm showing this graphically, because there are two other concepts which I'll be talking about, which we call as skewness and kurtosis. So before we go there, let's quickly do a recap of the mean and the standard deviation bit. This will be covered in detail on our slides in the quantitative methods subjects, but there's no harm in quickly discussing them now. So let's say this is a plain Gaussian. This is what we call as a normal distribution. Let's say this line shows my expected return. So as per the graph, we see that the expected return is zero. That is the mean or mu as we call it. We assume this to be zero. So this is like a long term or an equilibrium return which we are expecting. Now, whenever we are doing any kind of deviations away from this expected value on either sides, it could either be on the left hand side of the distribution or on the right hand side of the distribution. So this deviation away from the expected value is what we call as a risk in any investment. And that risk is something which we call as the standard deviation. We depict it by sigma typically. So always remember, whenever there is any kind of deviation away from your expected value, we call it as a measure of risk, which we measure through standard deviation. And we know that for any probability distribution, these two are important parameters because let's say even if we talk of a normal distribution, this will be completely defined by its mean and standard deviation. So these become like defining properties for any probability distribution. And these are also what we call as the first moments in our statistical analysis. So when we study things from MPT or modern portfolio theory, we study the assets from a risk and return perspective. That is, we take into consideration the first two moments. There are two higher moments as well, which we call as skewness and kurtosis. So let's understand skewness quickly. Again, these two concepts will be discussed in detail in our statistical analysis, but we'll do a recap of this. Now, if you focus on the diagram which I've shown at the top right here, we have a normal distribution here. So it's a uniform distribution and it is very, very symmetrical. That is, you'll say that there's a symmetry around this central axis. Now, if I just change this distribution a little bit, so either something like this or maybe something like this. So now I can't really say this is a symmetric distribution, isn't it? Because if I simply compare it visually, then the left hand side of the distribution and the right hand side of the distribution, they are not symmetric anymore, be it in scenario 1 or be it in scenario 2. So that's what we call as a positive and a negative skewness. So this is what we call as a skewed distribution. So this happens to be the third moment. Next is kurtosis. So kurtosis has to do with the height of your distribution. So allow me to draw a small graph which will help us understand this quickly. And I'll just draw two dotted lines, one above this distribution and one below the distribution. So the full line which I've drawn, this is a normal distribution or the Gaussian. So for a Gaussian, always remember for your examination that the kurtosis is equal to 3. So for a normal distribution, your kurtosis is 3. If you have a certain distribution which has a higher peak, something like this, as compared to your normal distribution, we call this as a leptokurtic distribution. So leptokurtic distribution has a kurtosis which is greater than 3. I'll just refer to kurtosis as K for short. Now, if my distribution is shorter than a normal distribution, so something like this, the second dotted line which I have shown here. So this is what I call as a platykurtic distribution. So a platykurtic distribution has a kurtosis of less than 3. So these are different types of distributions which we see in a practical market circumstance. And kurtosis equal to 3 is something like a benchmark. So whenever we say we are studying excess kurtosis or a certain kurtosis which is lower than 3, then 3 becomes a benchmark. So anything which is higher than 3 is what you can measure as an excess kurtosis. So let's say I have a certain leptokurtic distribution which has a kurtosis of 4. Then that will mean that I am calling it as an excess kurtosis of 1 because it is a kurtosis of 4 minus 3. So these are what you call as the third and the fourth moments. Now these are something which we do not use in the analysis of MPT or modern portfolio theory. And as we discussed, investors will seek a higher return for taking on higher risk. So again, that brings us back to the first two-dimensional chart which we had shown. We should analyze every activity from the portfolio management side in this two-dimensional space, which helps us relate a expected return on a certain asset versus the risk of that particular asset. Also, when we talk from a overall risk of the portfolio, we always look at it from a portfolio wide level or a portfolio management or overall portfolio perspective. So let's say I have five assets as a part of my portfolio. Then I will be looking at the risk of all the five assets and how exactly that is driving the total risk on my portfolio, and what are the expected returns which are commensurate to this kind of risk. So this is also, now these kind of expected returns is also what you call as a risk adjusted return. So always remember, from a portfolio management perspective, we should look at the risk from a overall portfolio level. So this helps us relate to a point called as correlation. So we commonly hear terms, whenever we study any kind of books on portfolio management, or even refer to any kind of newspapers or periodicals which talk about portfolio management or investments in general. Everyone talks about diversification of portfolio risk. So when we talk of diversification, always remember we are trying to use the concept of correlation. So when we say we are diversifying our risk away, what we are trying to do is we are trying to minimize the risk of our portfolio by combining the assets in such a way that if we look at the portfolio risk from an overall perspective, after taking into consideration the correlation of these asset classes, that will reduce the overall risk. That is, let's say I have, for simplicity, let's say I have two asset portfolio. So if it's a two asset portfolio and I have sigma 1 and sigma 2. These are the risks of my two assets, 1 and 2. And imagine that row 1, 2 is the correlation between these two. Then when I look at the overall portfolio level, I can't simply add sigma 1 plus sigma 2. If I call sigma 1 plus sigma 2 as the overall portfolio risk, that will be an incorrect analysis. Because if I do a simple algebraic addition, this implies that I'm ignoring any kind of correlation effects. And we know that there will always be some degree of correlation between assets. Now, even if we take assets which are from a different asset class, there will be some level of correlation. It could be a low correlation, but it will always be there. So when we measure the portfolio risk, it is important to take into consideration the correlation parameter as well. So this will help us understand the overall risk which is contributing from the portfolio wide perspective. So even from the overall asset allocation point of view, it is important to keep in mind that this correlation of assets among the portfolio is a very important point when it comes to portfolio decision making. Now, there are two types of risks which we always study in portfolio management or in finance in general. So one is what you call as a systematic risk, and second is the unsystematic risk. So synonymous terms for systematic risk is also what we call as a market risk. So a market risk or systematic risk is that kind of risk which will be, because the portfolio managers are doing investments in the market, they are exposing their investments to those kind of risks. Now, market risk is something which every investment in the market will be exposed to. You cannot actually get away with market risk, because we are actually trying to generate a certain set of return which is higher than the expected, higher than the risk-free return, isn't it? So if I look at investments which are riskier than a common risk-free asset, something like a government security, then naturally I'm adding systematic risk on my books, because only then will I be able to generate that excess return, isn't it? So always remember that systematic risk is something which will always be there. Look at any investment, but a systematic risk will always be present, because the movement in market risk factors is something which is going to impact my portfolio returns. And that is something which I cannot diversify away. So that is what you call as systematic risk, or synonymous terms for these are market risk as well. Next comes unsystematic risk. So an unsystematic risk is something, so you can imagine this is a risk which is peculiar to a certain asset. So let's say I'm talking of a certain equity share. let's say a certain XYZ company is an equity share, is a equity stock which is trading in the market. So yes, that stock will carry a certain amount of systematic risk because it is listed on the market, and the movements in the market are definitely going to impact the value of that share as well. But in addition to this, there is one more component which I need to take into consideration, which is a risk which is specific to XYZ Limited. So this is also what we call as a unsystematic or specific risk. Why specific risk? Because this risk is unique to that particular XYZ Limited stock. And that is something which I need to take into consideration when I look at my overall portfolio allocation. Now this is a kind of risk which can be diversified away. So this is where the concept of correlation, which we discussed some time back, comes into play. So what a portfolio manager will try to do is he or she will try to combine assets in such a way that when you look at a portfolio risk from aggregate portfolio level, that will actually eliminate this unsystematic risk completely or to a significant extent. So always remember for your examination, unsystematic risk is something which can be diversified away. And when we talk from a manager compensation, because compensation is also an important point, because every fund manager who is managing the investments for a certain investor will expect a certain level of compensation for the skills and efforts which they are taking. So a fund manager is always compensated for taking on market risk or taking on systematic risk because this defines the skill of the portfolio manager. So when we are benchmarking portfolio manager performance against the market risk or systematic risk which the manager takes, this takes into consideration the overall skill set or experience which the manager is using for managing the investments, and he will be compensated for this. However, a portfolio manager will not be compensated for the taking on specific risk because we know that specific risk can be diversified away. And something which can be diversified away, a manager will not be compensated for that because actual manager skill of picking investments is something which will not be impacting this kind of thing. Now, investment selection is something which will get captured as a part of your systematic risk part. But for unsystematic bit, we are simply trying to diversify away risk. So always remember, a portfolio manager will be compensated for taking on market risk. A portfolio manager will not be compensated for taking on unsystematic risk or specific risk. Now, just extending the plot which we had discussed earlier. So plotting expected return versus risk. So now we have shown a few portfolios here. Imagine portfolios A through to E are certain market portfolios, and let's say these portfolios are a combination of risky assets which are transacting in the market. And we have plotted everything in the risk and return space. So we have expected return, we can call this as E of R, as we had depicted earlier. And standard deviation, you can imagine this is the sigma portion or the risk of the portfolio. Now, a few quick points about this chart. Now there exists a portfolio which provides a certain highest return for every level of risk. So this first point is something which is going to drive these next two bullets which have been mentioned. So here we talk of the concept of efficient portfolios. So we'll elaborate about what do we mean by efficient and inefficient portfolios. So just taking a step ahead and then we'll come back. So portfolios A and B. Now these are considered as suboptimal portfolios. So let's see why we say that. Focusing on portfolios A and B, we see that these aren't really lying on this curved line which I have shown here. So this curved line is something which we are going to discuss in detail when we talk of the concept of efficient frontier. Now, why I say these are suboptimal portfolios? Because recollect that whenever we are studying MPT, we are assuming that the investors are rational investors. So for the investor, he'll always try to reduce the risk for a certain level of return. That is, if the investor has to take on higher risk, naturally there has to be a certain higher expected return which should be present. Otherwise, a rational investor will not take on additional risk. Now, if I take, let's say, an example of portfolio B here. So If I drop a dotted line from port which connects portfolio D and portfolio B, because these are on the same line. So here we see that portfolio D is giving a certain higher level of expected return, as shown by this green colored dot here, as compared to the expected return which is shown by portfolio B by the blue colored dot. So for any rational investor, given a choice, they will always go in for a portfolio D. That is because for a given level of risk, which I show by this cross here, for this given level of risk, they will be interested in taking a position in a portfolio which is giving a higher expected return. So at this same level of risk, portfolio B is giving a lower expected return, whereas portfolio D is giving a higher expected return. So any investor will always like to pick a portfolio D. So even from a fund management perspective, the manager will always go in for a portfolio D. Now, a similar logic can be applied for portfolio A as well. A is also considered suboptimal because it is not falling on this curved line, something which we will be calling as efficient frontier in some time. So that's why we say portfolios A and B are inefficient portfolios, because there are other portfolios which will give a higher expected return for taking on the same level of risk which portfolios A and B are carrying. So that's why we conclude that portfolio A and B are suboptimal portfolios. We say portfolio C and D are optimal portfolios. So here we'll introduce the efficient frontier. So we'll be talking more about efficient frontier in our coming slides as well. But if you see these portfolios, so starting from C right up till E, so we have spoken of C and D here. So C and D are considered to be falling on what we call as the efficient frontier. So efficient frontier is that mix of portfolios or that mix of portfolio assets which will generate the highest expected return for a certain level of risk. That is, these are portfolios which can be possibly constructed and which an investor can hold so that they can get a higher expected return for a certain level of risk. So that's why we say portfolios C and D are efficient portfolios, because they are falling on what you call as the efficient frontier. Now, another concept which we'll introduce here is a tangency portfolio. So portfolio C is called as a tangency portfolio or a market portfolio. So why I call this as a tangency portfolio? If I draw a dotted line from here, so the financial relevance of drawing this dotted line, we'll discuss in one of the subsequent slides. But for now, this dotted line is intersecting this efficient frontier at point C. And that's why portfolio C is something which we call as a tangency portfolio, or this is also what we call as a market portfolio. So as per the modern portfolio theory, now every investor which is holding the market portfolio will have a uniform set of expectations, or the kind of utility which the investor derives will be exactly the same if they are holding the market portfolio or the tangency portfolio. So these are synonymous terms. So anyone who is holding a market portfolio, you can imagine it's a combination of all the risky assets which are available in the market, and we have depicted this by the point C. And as we know, this will also be a part of your efficient frontier. So section C to E and beyond, this is what we call as the efficient frontier.